Over the next 45 minutes, I'm going to give you just the most brutally honest investing advice that I wish I could have given myself. And this is because years ago, I was completely financially illiterate. I was working a dead end job and I had no money for anything in my life. I didn't have a car. I didn't have a car for like 13 years. And now I'm at a point where, I've made over 100 grand in my business online. I've made content like this to be able to help other people. I'm investing. I have a positive net worth now. I'm in zero debt. And I want to share the stuff that I wish I knew to be able to get here. When I first started trying to change my financial situation, I was consistently looking for shortcuts and hacks, some stock that I could invest a lot in, or some skill that I could acquire that would bring in a lot of money without changing any of my other circumstances. And every time I did this, it wouldn't work. And that's because these short hacks don't create financial transformation. What actually does is discipline in being able to shift our identity. Shifting, it wasn't until I shifted who I saw myself as, who I'm growing into, and the vision of who I want to be in the world, and started actively trying to change into that in all areas of my life, not just my finances. It wasn't until I did those things that I actually started to see change. Tip number 2: the person who doesn't need the money has the power. And I shouldn't just say person, I should say entity. Or, whenever there's any type of business transaction, whether you're applying for a credit card with a credit card company, or you're buying a car, or you're buying stock, or there's a transaction between two parties, the party that doesn't need the money is the one that holds the power. Here's an example. I recently bought a car. I didn't have a car for 13 years. I know it's crazy. I don't even like to talk about that, but that was a byproduct of my financial missteps from years and years ago, right? And when I finally did buy a car, um, just the other year, I didn't want to drop. So I got a car loan, right? And because I had been rebuilding my credit, my percentage was like pretty high. My APR, so 25%. So I'm just paying it off super fast. But because I needed a car, like I got it. It was like I need it. And so that's an example. The person who needs the thing is the one who has the least power. In that situation, the car dealerships and the banks that were willing to give me a loan, those were the people who had the power, right? If I already had a car and I didn't need one to commute and do things, then I would be like, that's a bad deal. I'm not taking that. I'll wait till I find another one. And it's the same thing with all of our financial dealings. The person who doesn't need the money is the one who has the power. So do everything that you can to be that person. Tip number 3: increase your income to increase your investing velocity. So a lot of people will talk about budgeting, and I agree budgeting is a great thing. If you can budget and invest and save when you're broke, you're going to definitely do it when you make more money. But here's the caveat: you budget and invest and save when you're broke. And then when you increase your skills, this is what I did. When I started to increase my skills and start making more money because of this increased level of skills, I didn't let my lifestyle and my expenses go up with my pay raise. Whenever I got a pay raise or I started making more money, I kept my lifestyle the same and then put that extra money into savings, and particularly in a savings account where I actually earn interest, not just the savings account in my bank. Tip number 4: if you own assets, if you own things like real estate, or if you own a lot of stocks, where you have a lot of transactions, or you own a business, especially if you own a business, hiring a tax accountant will actually save you more than it will cost you. If you're just if you just have a W-2 and you're just working a regular 9 to 5 job with your W-2, don't have any assets, then that's not something that you need to worry about right now. You can do your own taxes. But as you start acquiring assets, let's say that you buy a house, you buy a duplex, you're selling stock, you're buying stock and you're selling stock. Well, there's certain tax advantages to all of these things. So actually hiring a tax accountant to be able to do your taxes at the end of the year, they're going to save you some money. And the money that they save you is going to be greater than the amount that you actually pay to have them on your team. And the only reason I know this, I don't have a tax accountant yet, but I am going to school full time for accounting. So I do understand a lot of this tax stuff. And I'm looking to go into tax. And that's how I know, like, yeah, if you have assets, it definitely makes sense to hire a tax accountant. So spend the money, get somebody good, and they'll save you some money. Tip number 5, investing in skills may seem to be like a step backwards, but it will always pay off in the long run. The biggest investment that I've ever made has been in myself. Yes, I am going to, like, me even going to school and going to college, that's an investment in yourself. A lot of people may not look at it that way, but when you're paying to go to school, you're paying to learn things, you're paying not just to learn things from the class, but you're paying for the network that you're creating while you're there. And you're creating for the you're paying for the different opportunities that are going to be afforded to you, um, and brought to you. But also, like me learning how to make videos on YouTube, I bought courses on this stuff. Me learning sales and marketing and being a sales rep a few years ago, and then having my own consulting business. All of that, I learned how to do that from paying other people. And when I started to do that, I started to invest in courses when I was still working this janitor job that I really didn't like in Los Angeles, making barely any money. And people around me looked at me like I was insane that I'm taking $500, which was like half of it was like maybe a quarter of my monthly pay or a third of it, right? And I'm buying courses like every month. They're like, "What are you doing? This is the dumbest thing that I've ever seen." The people that were around me, and now I can say, "Well, this that was a great decision," because those same people are still working there, and maybe they're happy working there, but I wasn't, and their life hasn't changed as much as mine has. And it just took some time for me to actually be able to develop the skills off of those investments and then leverage my way into higher opportunities. So it may seem like a step backwards at first, but it always pays off in the end as long as you take action on those skills. Tip number 6, I used to always try to figure out ways to bring in more cash and change my financial situation without having to change anything else in my life. That's all I wanted. I wanted my finances to be good and then not change anything else. And what I discovered is that for me, so here's what I was doing. I'll just get a little bit vulnerable. I was uh, eating really unhealthy foods. I had some really bad habits, unhealthy habits. I was, smoking a lot of weed. I was doing things that were just not good for me, and I was paying money to do them, right? And and I didn't want to change any of those things. I just wanted more money to come in, and that's it. And I did start to get more money to come in, but those other habits, those other things grew with the other money. So eventually, like the net income that I got was still zero, even though I made more money. And so eliminating bad habits in the beginning of your financial transformation is more effective than learning how to bring more money in. We want to eliminate the bad habit, whatever it takes. If you're like, let's say that you have like a gambling problem and that's why you want your financial situation to be better. Well, it's like the best thing that you can do is eliminate the gambling problem. Even if you don't change anything else, that's going to change your financial situation drastically if you eliminate just that, right? And I know that that is a very dramatic example, but that's how this works. If you have a shopping addiction and to the point where you're buying things on credit cards just because you want to keep buying things and buying things to make it feel good, to make you feel good, well, like eliminating that is the best thing that you can do, even if you don't change anything else. If you have a ton of credit card debt and you're just chipping away at it very slowly, the best thing that you can do is instead of saving and doing all this stuff, it's just like deploy all of that money to that credit card debt so that you're not paying interest on that stuff. Eliminate You want to remove the downside. You remove the downside, and that will have a drastic effect. This is where we want to start. Once we eliminate that downside, then we want to build the discipline to save, even when we're broke. Being able to save a certain percentage of what we make, even when we're broke, builds a habit. And then that habit also extends into our future when we start making more money. Tip number 7, if you want more, figure out a way to give more. Now, this isn't even really financial advice. This is more or less life advice. And I've found in my own personal experience that once I became somebody who was always looking to be able to give and help other people out, then other things in life in other unrelated areas started coming towards me. When people call me because they need help with something, I just answer, and I try to help as best as I can. I make this content, I make these videos to be able to help other people. Um, I'm also in a 12-step program for sobriety. I've been sober for 4 years. Whenever somebody asks for anything of me, I just do it. And I notice that when I do that, my life tends to just go a lot easier. And this is all based on the theory that life supports life. So when I'm somebody who's looking to help other people and support other people, um, either with my time, with things that I know, uh, it just makes it so that other doors and opportunities that seem totally unrelated tend to open in my favor. And so if you want more out of life, out of your finances, out of whatever it is, then try to be somebody who gives more. And then you'll start to notice doors opening up for you too. Tip number 8, if you're going to make a big purchase and you know that you're going to, and you know that your credit may be in the toilet, take the time to fix that first. I mentioned just a minute ago that I bought a car and I took out a loan to get the car, which is awesome because years ago my credit was so bad I wouldn't have even been able to do that, right? But so I knew that I was going to be getting a car, and I started making more money. And instead of just going and buying a car right away, I worked on my credit for about almost a year, and and I still had a high interest rate, but whatever. I'm sure my interest rate would have been a lot higher if I didn't work on my credit. And here's the thing: if you know that you're going to make a big purchase, you want to work on your credit first. The big purchase can wait a little bit, right? It can wait a little bit. You're going to end up saving money and interest in the long run. And that money that you save, like theoretically, could be put towards investing towards other things that we're going to get into later on in this video. Tip number 9, this is a big one that I am actively doing right now. And that is when it comes to the market, whatever market you're in, whether it's the stock market, whether it's the housing market, whatever you're investing in, we want to buy when the market corrects, and we want to hold when the market rebounds. And while the market is rebounding, we want to be building our cash reserves so that when it corrects again, because it inevitably will, we're able to buy once it's correcting again. And just to break this down real quick, we always want to be investing every month, like dollar cost averaging. And that's where you're putting a certain predetermined amount into investments every month, no matter what the market is doing. But at the same time, we also want to be stockpiling cash, like saving cash, so that when there is a correction, when everything seems to drop in the market that we know about, that we're knowledgeable about, that we've already been investing our time, our finances, and our attention to, and we see that, okay, the market's correcting right now, which basically means that all of these assets are undervalued because everyone's afraid. Everyone's afraid. So the assets are undervalued. We take this cash that we've deployed and then we purchase assets. We basically get assets on a discount. And this is what most really wealthy people do during market corrections, during recessions, and they just buy assets on discount. And then as the assets are going back up, as confidence is building in the market, and everyone's like going crazy and wanting to get into these investing opportunities because they see the markets going up, uh, people are just they're not buying huge amounts of assets like that. A lot of times they're not even selling them. It's like buy low. Everybody's heard this, right? They've heard buy low, sell high. But what really wealthy people do, and what I'm learning, is they buy low and they don't sell. They just buy low and then they hold. And then the next downturn hits in 10 years and they buy low again. And then they hold and they stockpile cash. And the next downturn hits and then they buy low again. So that's what I'm going to be doing. That's what I would recommend you guys do too. I'm just getting started with it though, so I can't say that I have experience with buying large assets like this during downturns, but I know that I will. Tip number 10, this is to plan for the unexpected. Like actually bake it into your plan. I have a quick story that I want to tell you about a time where I did not do this. And this is when me and my previous business partner we were selling a course on how to make money selling other people's products online. And it was doing well. We just released it and we're like 4 months into the release and we had somewhere around like 40K in revenue. Not all cash collected, but 40K in revenue over a couple months. And we decided, okay, let's go ahead and just start running ads. And we had this rosy outlook on like, okay, we're going to start running ads on YouTube. How it's going to work is we'll make 5 different video ads. Not nearly enough now that I know this. We're going to make 5 different video ads and we'll start spending. See, what were we spending? $200 a day on the ads. And we thought that, the product that we were selling was $3,000. So we thought like, we'll run these ads for a week and we'll get a sale within a week and we'll make that money back. And we didn't plan for things to go wrong. We planned for everything to go right. And then as soon as and that's just not how life works, right? Like the way that it works is you make a plan, you start executing on the plan, and then things don't go according to the plan, and then you have to figure it out and stick with it, and then you can eventually make the plan work, right? That's how things go in real life. And so we spent $1,000 in the first week, and then we freaked out that we didn't get a sale, and then we turned the ads off. And so we didn't figure out ads, not that year, figured out ads the next year when I realized what happened and said, okay, let's start with a little bit of a lower budget so we can get comfortable just spending the money every month and having nothing go right. And then we can figure out how to make them work. So it's like you make plans, but plan for the unexpected to happen. You want to bake it into your plan. This is called hedging. And so yeah, if you're buying real estate and you think, "Hey, I'm going to buy this duplex and it should cash flow this much per month." It's like, well, actually bake into the plan that, maybe 2 months out of the year, the units won't be occupied and you're not going to be getting rent for all 12 months. Also bake into the plan that, okay, bake into the cash flow. Well, what happens when a pipe bursts and we have, to randomly send a plumber in? And or if we have to repair the roof, like bake that all into the cash flow, like actually plan for things to go wrong and then see if the numbers make sense after that. If they still make sense, that's a good deal, do it. If they don't, mm, depends on how risk averse you want to be with whatever it is that you're doing with your investing. Number 11, our favorite, credit card debt. So we want to avoid high interest credit card debt at all costs. You can have credit cards and build your credit using credit cards. It doesn't mean you have to be paying the credit card company money. I did this. I think we all probably have examples of this where it's like you get a credit card, you start charging stuff on it. You're like, I'm going to be a credit hacker and earn all these points because I'm buying things and blah, 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 blah. That's what the credit card company wants you to do. And then we think, well, then we get the bill at the end of the month and we see the minimum payment. A lot of people know you got to pay more than the minimum payment. But here's the thing. If you leave a balance on there, you're paying interest on that balance the next month. And I did this when I first got my credit cards and I I decided that I'm going to only use credit cards and not my debit card for things that I buy. And then I got my statement came due the next month, and I just put like $200 on it instead of paying off the full balance. And then I didn't use my credit card the next month. I just didn't use it at all. And I noticed that my balance went up by like $80. And I was like, wait, what? I didn't buy anything though. And then I realized that that was my interest charge. That was what the credit card company was charging me because I used their money. And so now, when I can, I pay my credit card off in full every month. Because when you pay it off in full within a month, you don't get charged interest on whatever you bought with it. So you can still use your credit card, build your credit, get those points, all that stuff. If you want to play the credit game with getting points and stuff, and then you just come in and you pay it off with your actual money out of your bank account, and you don't get charged any interest because you didn't let that debt sit there for longer than a month. And if you have a high balance on your credit card, you definitely want to pay this off before you start looking into stocks and investing. And the reason being is credit card debt is usually around 20 to, if you have a good deal, it's usually 20 to 30% APR. That means if you have $100 on a credit card, and you just leave it on there, within a year it will be 130. And actually usually compounds like every single day, so it'll be more than that. But just for math purposes, we'll say that if you buy something with $100 in a year, that $100 purchase actually costs you $130. And so most investing vehicles do not give you that high of a return. So it's just math here, right? So if you put, the S&P 500 usually gives you about a 10% return year over year over a period of 10 years. So that's one third of it. So let's say that you're putting all this money uh, into the stock market to try to get a return, but at the same time, you're putting the same amount of money on credit card debt. Well, the debt is going to grow faster than your investments. So pay the debt off so that you have more money to be able to put into these investments in the future. Tip number 12, this personal finance stuff, it's a long-term game. And sometimes it can feel really hard to make decisions and have this discipline to be able to do this stuff like super long term. And something that helped me to stop buying, because like we're all humans, right? This is why it's hard. We like to buy things, and buying things makes us feel good, right? Like we get this new thing and we're like, oh cool, like I got this new microphone and I'm all stoked about it. I'm sure it's not making a big difference for my YouTube channel, but it's like I like it because I bought something new and I get to play with this new thing. And so we do this in all these different areas of our life, right? And so, one thing that has helped me do this less, one thing that has helped me do this less is I look at, but let's say that I wanted to buy something and it's $100. And then I think, well, if I put that $100 into just something as simple as my high yield savings account that gives around a 5% return every year. Like, okay, I could either spend this $100 on this thing and I have this thing, whatever it is, or I could put it in my high yield savings account and in a year it's $105. I basically pay myself $5 for not buying something. And when I look at things like that, when I'm trying to make a purchase decision, or when I'm at the store and my brain's like, you should get that too. I think like, well, okay, I could either buy that, I have that right now, or I pay myself this amount of money in a year because I don't buy it. And that has helped me spend significantly less and only buy things that I actually really need instead of things that my brain is just saying that you should go buy this thing right now. So hopefully that will help for you too. It just helps with reminding myself that this is a long term game. And the more I do that, the more successful that I am at it. Tip number 13, if you want to stockpile cash, put it in a high yield savings account. A lot of people want to just have their money in a regular banking account. But here's the problem with that. Your money is just sitting in a savings account. Well, the interest that you're gaining on it is lower than the rate of inflation. Let's say that inflation is at 3%. Well, if you're gaining interest at 3%, then you're not gaining any purchasing power over time. You may get 3% more funds at the end of the year, but so the number looks bigger, but the amount of stuff that you can buy with that number stays exactly the same because inflation went up 3%. So you want to make sure that if you're stockpiling cash, you're putting it in something like if you want it to be very liquid, you want to be able to get a hold of it whenever you want. It's not like in a 6 month certificate of deposit or something like that. You want to be able to just grab it to go buy assets on the fly, put it into a high yield savings account. This way, it's gaining interest that's higher than the rate of inflation, but you're able to access it at any time that you want. Number 14, we kind of went into this a little bit, but it's not letting inflation eat away at your savings. So you want to make sure that wherever you have your money parked, even if it's certificate of deposits, whether it's bonds, whatever it is, that's just sitting there as a stable source, as a stable little pool for your money to pile up in. You want to make sure that the interest that you're gaining is higher than the rate of inflation. Because if the rate of inflation year over year is higher than the interest that you're gaining, then that money is just slowly being siphoned off. The actual number of dollars in there isn't, but the purchasing power of that money is slowly dwindling over time. This is how inflation will eat up your cash reserves. So you want to make sure that it's sitting somewhere that is growing faster than the rate of inflation. Number 15, this seems like it's like a no-brainer, but it has to be said. Always make sure that you're investing in things that you know and that you understand. And if you really want to invest in something and you feel like you don't know or understand it yet, then maybe the first thing that you should invest in before investing in that thing is investing in yourself, in your education. I know it's the unsexy truth of the matter, but it's what's going to help it's what's going to help prevent you from like having massive losses in the future. You know, um, we all learn through experience, no matter what. And so we can pay to have some of that experience a little bit front loaded on like smaller deals and smaller things. Or we could like just go after the massively large deal and then that experience costs us a lot. I have a friend who is trying to get like $20 million in like business funding, so that he can buy a huge apartment complex in Los Angeles. And he wanted me to like try to get funding to go in on this deal like with him. Or so he wanted me to be involved in some way, shape, or form, whether it was as an accountant or investing with him. And and I said, dude, I don't have real estate experience yet. And he's like, well, neither do I, but I'm gonna do this stuff. And I just thought like, like it could work out. I opted to not do it, but it could work out for him. I hope it does. But the thing is, with deals like that where you don't have experience, if you get it wrong, the risk is huge. If you get it wrong, the risk is huge. So I like to take small investments in things that I don't know, small ones, because that gives me the experience to know more about it. And I only take it like larger investments and things that I'm highly confident in, highly knowledgeable in. And the thing with your confidence and your knowledge is it grows over time as you take more action and do more stuff. So that means that none of this stuff is going to be a one and done thing where you just dump some money somewhere and then magically you're, financially free later. Those are the highlight reels. When you see stories of people doing that, it's because they put in a massive amount of work beforehand to understand exactly what they're investing in and what they're doing to be able to make that one off home run looking investment that you see work for them. So only invest in things that you know and understand, build your knowledge and understanding to be able to take bigger investments without them being that risky for you. Kind of on the same note, we don't ever want to bet the farm. But there's a little caveat because we hear people say this all the time, like, don't bet the farm. And what does this even mean? It means like, don't put all your eggs in one basket. And like we hear a lot of people saying stuff like this, right? But if you are at a spot where you are basically at zero, right? Like when I was working that janitor job and I was making $750 every 2 weeks, and my rent for the room that I was renting was more than that. It was like $850, $900. So it's like 65, 70% of my income was just going to the room in Los Angeles that I was renting, right? Uh, well, I didn't have a farm to bet. So me paying $500 for a course to learn how to make some more money was like some people look at that like that's stupid, but it's like it's actually not that stupid because it's like I don't there's no farm to bet here anyways. It's like, oh, I lose it all. Like what am I going to lose? It's like I just go back to work for 2 weeks and I make that money back. I didn't have I didn't have a house, a mortgage. I didn't have a bunch of assets and a bunch of things that needed to be paid or else they go away. I didn't have a family. I wasn't in a relationship at the time. Didn't have any pets. It was just me. It was like, okay, like worst comes to worst, I gotta grind it out and eat like sweet potatoes for 2 weeks straight because I have no money for food. As long as I pay the rent, I'm good. Anything else after that, like I could figure it out. And so never bet the farm when you have a farm. When you don't have anything to lose, you can be the most dangerous person in the room. Because when you don't have anything to lose, you can take bigger risks. But once you've started to stockpile some wealth, once you've started to build your credit, once you've started to actually grow your portfolio, don't ever bet the farm. On top of that, don't ever try to time the market. And I know this may sound conflicting with what I was saying before when it comes to when there is a downturn, we want to buy assets. And when there is uh, like a recovery, we want to hold on to them. Um, so we don't want to time the market. Don't wait to invest, waiting for that downturn is what I'm saying. We still want to be dollar cost averaging, which is basically where you're putting a fixed amount of money into certain things every month, no matter what the market is doing, and also putting some money into some savings. Just to give you an example, I have it on this little sticky note. This is like what I do, right? So because I want to stockpile some cash so I can get into real estate, um, out of what I have to invest every month, I put 50% of that, 50% of what I have to save and invest. 50% of that goes into a high yield savings account every month. 30% of what I have to save and invest right now goes into stocks. And out of the stock stuff, I won't tell you exactly what stocks I invest in, but out of the stock stuff, out of the money that I do put into stocks every month, 50% of it goes into S&P 500, so just very safe. And this is like I'm not pulling it out ever. So I'm putting it in there. It's my retirement, right? It's going to S&P 500. 40% of the money that I put into stocks goes into other companies that I've looked into that I think are doing well long term, that have been and continue and will continue to. And 10% of the money that I put into stocks goes into speculation. This is like bets. This is where I'm like, hey, I could lose all of this, or it could turn out really well. Whatever. Let's see. Um, and then another 20% of my savings and investing goes into online business expenses, because it's stuff that I know about. I know about running ads, making YouTube videos, creating content, selling affiliate products, having an email list, things like that. That's an example of my dollar cost averaging. And but I wanted to explain that to you so that you can see that I'm putting a lot of money into cash still, my high yield savings account. And that's because I'm getting ready. I'm not timing the market. I'm still investing into stocks and into other things, but I'm still putting cash aside so that when there is a downturn, I can buy other assets. I can buy real estate. I can buy other things because I have this stockpile of cash. But it would be a mistake if all I was doing was putting all of that money into a high yield savings account, just waiting for the market to do what I want it to do. Because it could take a decade for that to happen. Usually downturns happen once a decade. So it's like, don't try to time the market and then put all your eggs into that market timing. I mean, you could make a lot of money doing that, but you could also lose all of it doing that. Oh, this next one, this is a quote from the great Warren Buffett, probably the best value investor of all time. And what Warren says is that when others are fearful, actually, we'll start it the other way around. I think he says, when others are greedy, be fearful. And when others are fearful, be greedy. Now, he's talking about the market conditions. So when you see that everybody's operating out of fear, and this is what happens during a downturn, and it's what happens for 2 quarters in a row when there's a recession. People are fearful. People think that things aren't going to work out. They're not hiring as much. GDP goes down. Prices on stocks and on different assets go down. That's when it's time to be greedy. And by be greedy, he means, hey, deploy your cash and buy some stuff while it's at a discount. See a bunch of homes starting to foreclose, and there's like a housing crisis. Like I wish that I had been doing this before 2008. I wish that I was stockpiling cash and just had cash to deploy in like 2009, 2010. And there's a bunch of homes that were being foreclosed on. But I didn't. But the best thing I can do now is learn from me not doing that and be in a position to be able to do that when there is a downturn. I'm not saying there's going to be another housing crash. There's all these videos right now saying that there is, but there always is a downturn. This is how the market fluctuates. It does it like every 10 years. There's some sort of downturn where it goes up and down. I'm not saying it's going to be as extreme as it was before, but there will be one. And when there is, I will be there to be able to buy, to be greedy when others are fearful. And when other people are being greedy and everyone thinks that everything is going great and the economy is going great and you should invest in all these things and there's all these opportunities coming your way because everything's great and the economy is going to be great forever. That's when it's time to be like, oh, this is okay. Everyone thinks everything's going to be good forever right now. So maybe I'm going to be a little bit more conservative and not just invest in all these things, hold on to my assets. And doesn't mean I need to sell all my stuff off, but I just need to take a step back and just look at what's going on here because they call it an economic cycle for a reason, right? And it's very easy to talk about, a lot harder to do. Okay, so tip number 19. It's not about how much you make. It's about how much you keep. This goes back to discipline, being able to save and invest. I used to think that when I had that job, that janitor job, and I was basically making shit money and working my ass off to do it. I thought the answer to all my problems was just making more money. But there's plenty of people out there that, I think I was making like 30K a year, if that, when I was working that job. Actually, no, it was less than that. Like 20K a year, right? Living in Los Angeles, crazy. I was making somewhere around that, and at the end of the year, I had all my money was gone. Nothing was in savings, nothing was in stocks, nothing was being invested at all. But then there's other people with 200K per year jobs that are in the same boat, that are paycheck to paycheck. And it's not about how much you make, it's about how much you keep. I would much rather be the person who makes 70K a year and is able to save 20K of that at the end of the year. So I only spend 50, even though I made 70, than to be the person who is making 200 and spending 200. And I say that because over a period of 30 years, um, the person who's making 70, spending 50, and putting 20 into investment vehicles, like whether it's high yield savings accounts, stocks, they have a portfolio that they're going to be well off compared to the person who is just spending every single dollar that they make. It's not about how much you make, it's about how much you can keep. And really, it's about how much you keep because that is what's going into your savings and investing portfolios. How much you keep dictates how much you will have in the future. So I don't know about you, but it was really hard for me to just start putting chunks of money away to invest and to save. And I used to look at, I would get paid and I would pay all my bills first. I was trying to be very responsible. I get paid. And I'm like, okay, we're going to pay the rent, pay the credit card bills. We're going to pay the phone bills. We're going to go out. We're going to buy all the groceries. Now I'm going to plan what I'm going to do with, with my girlfriend and the different things coming up over the next month and budget all that stuff. Then I would look at what's left and think, okay, what percentage of this of what's left do I want to put into savings and investing? It was literally the last thing on the list. I had all these other people and places and things to do, all these different lists of people to go pay. And then after they're all paid and they all get their money, then I would look at what's left to save and invest, right? And and because I did it this way, it just never worked out. So here's the shift that I made. I decided to just pay myself first. So instead of taking that savings and that investing and having it be the very last thing that I do, instead, I say, okay, how much of my income do I want to save and invest? I decide what the percentage is before I get paid. And then when I get paid, I remove that percentage out of, like, as soon as the money hits my account, I transfer that savings and investing percentage out of my account. And then out of what's left, that's when I pay the rent, the bills, all the other things. So this is paying yourself first. It's actually paying your savings and investing portfolio first before you pay anything else. And this just made it so much easier for me. Now I do it every single month and I'm saving and investing more than I ever have because of this principle. Okay, so tip 21, if you're in a spot where you just don't really know what to invest in or where to start, we all start there. I was there too. The best investment that you can make is in yourself. And I say this because that's what I did, right? To go from somebody who's working a really dead end job with no savings, all these terrible habits, terrible credit. Like I couldn't get anybody other than a loan shark to like loan me anything. They're like, no. And it had basically nothing going on for my future. It all started with me investing in myself to level up my skills. And so investing in yourself is the best investment that you can make. And I still stand by that. That's why even after buying all these different courses and actually like starting a business and making money online doing it, I'm still going to 4-year university to go to school for accounting. And it's because I know that me having these accounting skills, really understanding it, being accredited, going to an accredited university for accounting and having that skill set in my pocket, it's going to serve me for life. So like you can never go wrong investing in yourself. This next one kind of piggybacks on that. Investing time and investing money to be able to acquire a skill or a set of skills will always give you a return. And even if it's not just, I mean, as you're doing this, you're investing in yourself. So that's why it's always going to give you a return. But it also makes you more valuable to future employers. And it also gives you more experience in case you want to start your own business. Maybe you don't even want to start your own business. Maybe that's like just too much. You don't even want to do all that. But I guarantee that the more skills that you bring to the table and the wider that your breadth of knowledge is, as long as you have one area that you can go super deep on, where you're very like your skills are focused in one area, and then you have the adjacent skills next to that, you understand those two, you become a more valuable employee to wherever you're looking to work. Me understanding sales, marketing, and accounting, and also like management, like puts me in a position to be able to be an executive in the future at a company instead of just an accountant because I'm understanding all these different aspects of how money is flowing in and out of a business, which increases my ability to be able to earn more, which increases my ability to be able to invest and save more. All this stuff is really cyclical. All of that being said, investing in your skills and in yourself is huge. Last but not least, avoid the high interest credit card debt. Pay it off before you start looking to just dump money into a high yield savings account. I might have mentioned this already in the video. We've gone through a lot of tips here. If these things have been helpful for you, share this video with somebody else that you think that would help, and consider giving a like to the video. I know it sounds dumb, but it actually helps. It helps YouTube show this video to other people that it might be able to help. And you get to support the channel just by giving it a like. It takes 2 seconds. Really appreciate you for sticking around at the end. We'll see you guys in the next video. Take care.